Thank you, everybody, for attending today's session. It is with our good friends at GrowthLab, Korey and Dan, and we are talking about the financials of what we should be doing as we look to 2021. What happens next? And so with that, Korey and Dan, I'm going to pass the baton.
Today we're going to be talking a little bit about the recent stimulus package that was passed, particularly PPP round 2, some of the tax impacts, some of the business strategy impacts that come out of that, as well as kind of looking forward through 2021, what to expect, what to think about, places to cover your bases.
Before we jump into that, let's spend just 2 or 3 minutes on this week's events. It's no doubt that 2020 has been a tumultuous year. A lot of pain, suffering, challenges, but a lot of opportunities. Some of the events that happened this week, I don't think as business owners we should avoid it. I think as business owners we need to embrace what happened and give employees the opportunity to feel it. Take the time to talk about it, regardless of what side of the aisle you are. The events of this week, really one does show how fragile democracies really are. We live in a country of great opportunity. I am the son of an immigrant, and you're probably not too far off from second generation. But, having a strong democracy where we don't take it for granted gives us the foundation to enjoy the fruits of a moderate capitalism, right? Mm-hmm. Competition is so critical in achieving our financial goals. So anyways, I just wanted to kind of start off with that everybody takes this very differently. Others require more time to sort of reflect on it and process it. Others,
But I think that theme can be said 6 months ago, 12 months ago, like that. We went through a period of like extreme economic growth, right, after 2008. And for small business owners that started in 2008 or the aftermath of 2008, it was great times, right? And no one expected this. We kind of took it for granted, to your point. And then whether it's COVID, whether it's these issues that you're talking about, I think they both come back together, right? So that not taking things for granted. It's a theme.
And when you think about planning for your business, you have to look at these. You have to think about these things. The last 12 years, when you hit rock bottom in 2008 through 2009 and 10, you can only go up, right? That one just took 10 months to kind of go up. I always said at the beginning of the pandemic, this story has been written before. It's just the last few times this has all kind of happened on an economic front. It's taken an entire novel, right? Mm-hmm. This time around in 2020, it was literally the story was written in a chapter. And so anyways, with that, one of the things that kind of really kept us up all night going into the end of the year was the tax implication of the PPP loan. For some, it really wouldn't have mattered because the PPP loan essentially was used to pay for expenses such as payroll that otherwise these companies probably would have laid people off. So let's just say they used the money for what it was originally intended for, right? Mm-hmm. Others didn't really use the money for what it was really intended for. They actually used the money in the way we wanted them to use it, which was, shore up the foundation of your company, whether it meant taking a critical eye and analysis to your working capital and adjusting your working capital with the proceeds of the PPP money so that, as things did improve and you could begin to bring the majority of your employees back and your customers were coming back, you would be in a better position. That those companies that did that, they're the ones that could have ultimately have truly suffered from the tax consequences of the PPP money because they did right-size the business. I will tell you this, for the companies that actually took the PPP money and used it for what it was originally intended for, which was the retention of employees, they're actually finding themselves in a pickle right now. because the funds have been exhausted, but yet the customers haven't come back. You know, you look at Wall Street, but you also have to understand the magnitude of the increase of where the markets are today versus in October. They're attributable to essentially 4 or 5 companies. For every dollar the market goes up, it's like 80 cents of that dollar is attributable to like 4 or 5 companies. It's not the entire economy that's
The market doesn't no longer portrays the Main Street businesses.
and so one of the best things that Congress and the president, I mean, they essentially gave us a Christmas present, if you will, in the mid-December, because I spoke to many people and congressmen. Nobody really thought this was going to happen. So with that said, it did happen. And so Korey, you want to run through some of the sort of things that we should be thinking about in round 2?
Yeah, so we're going to focus this part on the PPP. I know that with the stimulus package, there was also conversations on another EIDL grant, or another EIDL loan, rather. That detail has not been finalized, and so we are kind of just putting our eggs in the PPP basket for now, especially with some of the recent updates in terms of like the tax implications of that, right? I think a lot of people were hesitant up front to take or even think about another PPP because of the potential tax implications. So round 2 kind of looks somewhat similar to round 1, frankly. What they're defining it as now to be qualified is less than 300 employees, aka truly the small businesses. That was one of the big pushbacks, or one of the biggest conversation pieces on round 1 was who actually got this PPP. Secondly is a 25% drop in gross receipts. This is kind of up in the air. That's why gross receipts is in quotations. Not quite sure what that means yet, to be honest. Is that cash? Is that accrual? Is that bookings? What does that really mean? So,
but the good news there is that you can actually, the line in the sand for 2019 versus 2020 or vice versa, is that you can pick
what quarter.
So
Yep.
you could look at, and this is great for seasonal businesses. This is actually helping out some of the customers that we've been working with. So you could technically look at Q1 of 2019 versus what you did in Q1 of 2020. The other big thing that came into this was you could be a startup too, right? So
you could have been founded after February 15th, which was not allowed in.
Although I don't know how that kind of plays into the 2019, 2020. You know, the guidance really hasn't been solidified, but what I would recommend that customers do and companies do, and which we've been proactively kind of doing, is just go into your accounting, pull your 2019 accrual-based revenue, pull your cash-based revenue by quarter. And if you are in that type of business where you have gross revenue minus some pass-through costs, and therefore you have a net revenue, this could be very interesting for time and material type of companies, right? Even pulling that net revenue, now you've got 3 lines, you know, whether or not this is correct, you know, and when the guidance finally comes out, but at least you're prepared. So you've got 3 types of numbers. You've got 4 quarters in 2019, compare them to 4 quarters in 2020, and then you kind of have a sense of where you sort of land. And then the next thing you do is call your banker, right? Call your banker and express the interest that you are going to be reapplying.
I think that's something key though here, is because round 1 has passed. People that got round 1 they already know they're qualified for round 2 because of the fact that they've had such a dip in revenue or gross receipts. They're expecting it, right? They've probably already had the same materials prepped up because you can use the same headcount numbers and payroll numbers. And so they already have that information set aside, right? So take the time now, get as many of those different gross receipt numbers as you talked about, because when that door opens to apply,
you want to be the first in line.
You want to be the first in line. So that's kind of the qualifications. In terms of the amounts, from what I was just saying, it's pretty much the same as round 1, unless you're in the hospitality, right? You can either pick 2019 or 2020 average payroll numbers. There's some movements in there for seasonal businesses that are kind of one-off, but generally speaking, it's either 2.5 times your monthly payroll cost, or if you're in hospitality, it's 3.5 times. The only thing now is there is a cap. I believe that cap is $2 million. So you cannot get in total more than $2 million in PPP funds, whether that's from round one or round two or both. And then lastly, on the forgiveness side of things, upfront, wait, do not apply. We are telling our customers, hold off on applying for forgiveness. Whether or not you want to apply for round two, wait. Comes down to two reasons. One, they're going to be coming out with a simplified application for forgiveness if you have less than $150,000 in PPP funds. So that will make it much easier for you. Secondly, what we've been hearing is that if you are planning to apply for PPP round two, if you apply for forgiveness on round one, your application is now in essence closed, and your application for round two is going to be a much larger process than it would have otherwise. So
Yeah, essentially your file is still open with the SBA.
yes, so keep that file open, don't apply. And then lastly, one other thing I'm thinking about is we've had some customers that have applied for round one forgiveness weeks ago, and we do not know right now if they are grandfathered into these new updates that we're going to go into in the next slide. So with that being said, I'm going to skip around here to the PPP tax impact. So huge win.
Yeah, I remember working in the restaurant industry when I was 18 or 16. So this goes back to like 88, 89. And I remember in the restaurant industry, I think it was like that year that the IRS or Congress actually disallowed businesses from deducting 100% of the meals, right?
Yeah.
That's when I believe that's when it originally went to that 50%. It kind of stayed to 50% until 2 years ago with the new tax law, or 3 years ago, I lose my years here, where, depending on the type of meal, was it a meeting meal? Was it a business meal? And then obviously entertainment. So we lost a lot of those deductions over the last 2 years or 3 years. And this is, I think, is a big win both for the hospitality, specifically the restaurant industry, and for businesses, right? Because having conversations with folks now is like, what does business development really look like? People are, some people are thinking, oh, we're going to go back to the office, everything's going back to normal. It's like, no, not really. We're human, we build relationships. We just have to learn how to build relationships through more of a virtual platform versus physically. But I think having the meals back in, I personally, do I think twice about how much I'm about to spend if I'm taking a customer out or a potential prospect? Yes and no, but I think this is a great win both for the restaurant industry, and I believe it's a great win for businesses. So yeah, that's a big win overall. So
yeah, I think we'll see a lot more businesses ordering delivery. PPP tax impact of that. So PPP tax impact, this is also a big win. Essentially, without going into too much detail, in round one, the expenses that you used for forgiveness were not going to be tax deductible. Now they are tax deductible.
Although that was not the intent of Congress.
It's not the original.
It was the guidance the IRS provided in November, and that could have caused a huge cash crunch. Essentially, if you want to kind of boil it down to numbers, of the $600 billion that were, or 500 billion, whatever the last number was, that was pushed through the first tranche, if we were to tax that money, which essentially that's what this would come down to, you would essentially be removing $250 billion of that economic stimulus back out of the economy at a point where you really needed it. So kind of crazy, right? It's kind of like, give me $1, but you're going to give me 50 cents back. So. And then the AIDL grant, so the $10,000, which is also a nice little win.
Yeah.
So cool.
And then lastly, kind of just in closing, kind of recapping this, bringing this all together is, 2021 planning, right? It's January 8th, first week of the month, or first week of the year, excuse me. What does this all mean, right? We started this kind of presentation off by having conversations around like changing your business around, right? Like just because COVID is, knock on wood, on its way out, right? Or the vaccine is being rolled out, things are starting to open out, expectations of some form of normalcy in 2021 at whatever point that is. What we're basically preaching, what we're trying to tell businesses is don't expect a full back to normal, right? Don't plan your business expectations around things opening back up and people are just going to be flooding back to your business, right?
Yeah, it's funny. I was having this conversation with a former Goldman Sachs investment banker. He now runs one of our startups, and he was asking me, he's just like, so this whole thing about an office, right? Are we really going to go back to the office? And you know, because what you're not just seeing anecdotally now, you're actually seeing people moving.
Yeah.
Moving out of the city, moving out of the West Coast, the East Coast. I mean, we're seeing it with a lot of our customers, our service providers, our vendors, families, friends. So this notion that things are going to be back to normal is not true, you know, and I do believe that there's a paradigm shift and it's here to stay. And part of your planning around this is like, you know, and by the way, it's going to be a good cost savings for companies. And so one of the conversations I had with this Goldman guy was, okay, so if we don't come back to the office, how do we train millennials? And it's like, well, yeah, that's exactly what we've been preaching for a while. So how you're going to be doing what you're doing and how you've done it in the past is going to look very differently. But there's also going to be cost implications, right? Because at the end of the day, guys, you may be saving money on, say, physical footprint, but then you're going to also be losing opportunity because it's going to take longer to train new college grads, for example, coming out of college. You hire them. Instead of taking 3 months as they're shadowing you and they're listening and they're attending meetings, right? I look back, so one of the stories we exchanged was, I look back at my career when I was your age. I was fortunate enough to have managers who let me into meetings. And, you know, you didn't say anything, God forbid you'd say anything, you're kind of in the corner, but you listened and you were present and you could you see the interactions, you were learning all these soft skills,
Absorbing.
right? That's hard now. That's very hard, which is essentially means it's, you know, getting even technical folks up and running in 2 to 3 months, achieving that break even, if you will, that's going to take longer. So we are working with one customer who's very much in the human capital business. And it's just like, yeah, it used to take you 3 to 5 months to get break even on an employee. And now we're looking 12, 14 months. So,
yeah. On the flip side of that, though, playing devil's advocate against that is also with this remote workforce, this does open up the opportunity to tap into talent that you wouldn't have otherwise.
I agree. But you're also at, you know, you're on the verge of sort of dealing with multi-state compliance, right? You know, like
it's an HR.
It's an HR nightmare, and you know we think we're pretty savvy with HR, and we're starting to deal with. I mean, so we just went over to a PEO just to try to simplify some of this stuff. But now we have legal fees and more insurance. Like our insurance bills have increased by easily 100%, just because we know we need more insurance. We need more legal advice. So yeah, 2021, you know, there was that great article in Wall Street Journal. I think the book was released right after Thanksgiving. They talk about like the transitional periods. Like, are we in the immediate aftermath? Are we still in it? I believe like 2021 is just really an extension of 2020. It's just we're beginning to learn to live with this, right? So here's Korey and myself without masks, but we're getting tested, right? Family members are getting tested, like, and sort of like we're in this 3-family pod, if you will. We're sort of living with it, but that's it. We don't see anybody else, you know. So
yeah.
Anyways,
and then kind of lastly, kind of recap that, close that out is, you know, what we've been focusing on a lot with our customers and with businesses we've talked to is that 2021 plan, right? This is nothing new. We've presented this in the past, I think last month as well, is like, if you have not finished your 2021 AOP, your budget for this year, like that's top priority going into this year. On top of that, having different buckets for it, right? That best case, worst case, medium case scenario. What does that look like in the paradigm of everything we just talked about? Potential for new PPP, tax implications, potential for reopening versus not reopening, and so on and so forth. So,
yeah, I agree. And one of the things that also needs to be part of the 2021 planning, which probably has not been top of mind for many businesses, is that, let's face it, there has been a levering process. We have gone through some levering here, although the PPP forgiveness is going to be a nice de-levering. but you can just assume that most of those monies were just used to sustain the business. But for those companies that did take EIDL, that have increased their debt, now you need to start thinking beyond 2021 and how do you pay that debt back? So, starting put together that debt repayment schedule if you have taken on debt more than you intended. Great article in the Wall Street Journal, I think it was this week, on the Main Street lending program. So you have these lower middle market companies that have taken $500,000 upwards to like $5 million in new debt, right, from the Main Street lending. You got to pay that back. How do you pay that back, right? How do you start allocating some of your free cash flow to delevering your balance sheet? So,
Awesome. Thank you. This is a great way to kick off 2021. We always love your updates, and you're always out there first sharing information about all of this important, all of it. And we appreciate you sharing your time. So
excellent. Cool. Happy New Year.
Happy New Year.
Awesome.